which we want to bring in right now BlackRock Global CIO of Fixed Income, Rieder. And Rick, it's always a pleasure to talk to you. Thank you so much for joining us, because we've had all of these new signals in the last couple of weeks. First, let's talk rates, because the interest rate market has been really the fuel for the volatility in the stock market. Isn't that right?
So I think it's what started it. I think actually if you go back to September when the Fed came out and said we're not sure where the neutral rate is and we may be far from it. You talk about something markets can't take. It's uncertainty around the discount rate on your assets. Since then, you're starting to get some better news out of the Fed. I mean, we're going to hear next week. I think the dynamic is they're probably going to go next week, unless the markets really have a hard time the next few days. But they're going to go next week. But then I think it's going to be completely data-centric from there. And quite frankly, the interest-sensitive parts of the economy, housing, auto, small business, you're seeing some tangible softness. So, it's changed the dynamic. By the way, it means you can use interest rates now in your portfolio. We've talked about in your show for a long time, just by 2 years, because that's where you don't want to get hurt with rates rising. All of a sudden, rates don't have to rise anymore. It's a really big deal for markets longer term. It's
a really big deal. And you were on the show about a month ago, and you said, look, there are opportunities in the short term.
Yes.
The 2-year and the 3-year even, or the 10-year, so close to 3%. But, I go back to what President Trump said about Jay Powell. And, you got to say, even though you really don't want the president of the free world telling the Fed how to operate, he was right. I mean, he was looking at the economy and saying things are slowing. Maybe you don't need all these rate hikes. Yesterday, he was on Fox News, and he said he hopes the Fed doesn't raise interest rates anymore. Watch this.
You look at inflation, it's very low. Hopefully the Fed won't be raising interest rates anymore, because if you compare us to, as an example, President Obama, he had 0 interest rates. Anybody can make money with 0 interest rates. I'm almost at a normalized interest rate, and yet our economy is soaring. Our jobs are soaring. Our businesses are doing tremendously. Apple just announced they're going to be investing billions of dollars in this country. That just happened.
So the economy is doing well, but not all that well, because the expectations are that things are going to slow in the coming years, right?
Maria, I think there's some really big points here. I think there are a couple of things to be said. First of all, the Fed's moved 10 times. You can step back and look at the grand landscape of what's happened, and some of the interest-sensitive parts of the economy are slowing.
10 times is a lot.
It's a lot. You've moved the front end of the yield curve. You've moved real rates back over 3%. It's a very big deal. Second thing, there's something really important. We should put more and more people to work in this economy. When you increase jobs, wages are accelerating a bit. Wages doesn't mean inflation. What more and more people are doing is they're actually saving. It's not like 20 years ago where you buy a new TV, new radio. Because of services, because of technology, you don't create wages up, then inflation rises. The Fed has nothing to be worried about. Put more people to work. When you think about what people have in terms of college costs, in terms of retirement, et cetera, put more people to work. There's no reason. We don't have to choke off the economy. But I do agree to some extent that given how much we've moved, the Fed can take a step back, evaluate the data, maybe get another hike in next year or two, but let the economy gain its footing. Actually, the economy's in good shape. We're just going to slow a bit from what is a very, very strong pace. But you don't have to keep moving. If inflation's not chasing you, inflation is decelerating a bit. It's pretty impressive.
And this is exactly what Ray Dalio said when he came on the show last week. He says the Fed's not going to be able to do it. They're not going to be able to raise rates 3 times, which is what a lot of people are saying. Now you're saying 1 or 2.
No, I've been saying I've said on your show last time.
You've been saying a long time. You came on this program 2 months ago, 3 months ago, and said that the Fed is not going to be able to raise rates that much.
There's no way. I mean, do they go 1 time next year, maybe a second time? I think they're going to try to. That being said, Maria, inflation, top-line inflation is going down to, we think this year, down to 1.5%. An economy that's still growing at over 2%. It's pretty good. But it doesn't mean you have to lift interest rates. Right. Their goal, the obligation of the Fed is price stability. It's not 2. It's price stability. If you're trending to 1.5, you're putting a lot of people to work. Let it go and evaluate it and see, gosh, do we need to? Is inflation accelerating a little bit? Then you could tweak it. But right now, no need to.
And how about those inflation numbers? I mean, the CPI yesterday was a yawn.
Right.
The PPI is a yawn. There's just no real significant moves in terms of inflation.
So, Maria, I think it's, we talked about earlier about the structural changes in the economy. You talked about autonomous cars. You look at transportation goods, what's happening versus 10 years ago. You look at food and agriculture.
That's a great point.
Cost of food is going down. Cost of transportation is going down. Cost of apparel is going down. We don't get accelerating inflation like you have before because there are structural dynamics in play in what is it was an economy today that's different than others. When people say wages up, inflation's coming, it's going to overheat, it just doesn't happen.
Okay, but real quick before you go, I mean, are you worried about growth? Because yes, the Fed might not be able to raise rates as much, but that's because the economy is growing, but it's about to slow. So how worried are you that European issues are going to impact the U.S., China issues are going to impact, and the slowdown accelerates?
So I think you can't discount them entirely. By the way, there's a series of things in Europe, including exports to China, that could improve. There's a water issue in Germany. There's French protests. I don't think that Europe's falling off a cliff, and I think China will start to stabilize. The U.S. is going to grow over 2%. We're going to hit an unemployment rate in this country in the low 3s, maybe 3%. Pretty hard to go into a recession when you have that many people at work. So I'm not worried about the U.S. falling off a cliff or going into a recession anytime soon. Just slower growth.
Do you still want to buy the front end in fixed income? What do you want to buy?
So not only do I still want to buy the front end, I love the front end, but for the first time or in a long time, I actually like owning longer-term interest rates because now you have a Fed that will be data-focused. It means when you own a portfolio of equities or other risk, gosh, interest rates in the longer end of the curve can actually now move with my risk or help me against my risk. It's a really big deal.
So you're talking about the 10-year, the 30-year?
The 10-year will work, the 30-year less so because of how flat the curve is, but certainly the 10-year Treasury. I think you can own fixed income again.
Just under 3%. It's a nice return to get.
Pretty good.
Rick, it's great to have you on the show.
Thanks for having me.
Thank you so much. Rick Rieder, you're going to be my special guest this weekend on Wall Street, so thank you for joining us on that. Rick Rieder from BlackRock.